Smith.
And I'm Chuck Osborne,
And welcome to the Iron Capital Podcast,
where we break down investment stuff with anecdotes and stories that non-financial geeks can understand.
Hey, this is Michael.
And this is Chuck.
And it's Wednesday, November 1st, 2023, the day after Halloween. And this is the 7th episode of the Iron Capital Podcast. So I'd say let's get to it, Chuck. But first, how was Halloween?
Halloween was good.
Yeah.
Yeah. We had a lot of activity at our house, so It was good.
We got like 350 people or so that come. It's like a play. You get drop off of kids practically in buses and stuff. So it's wild.
Holy cow!
Yeah.
Yeah, we went with the full size candy bars this year.
Oh, how would that go?
And it went all right. Although there was one little kid that came and was like looking around the bowl to pick something, and he's like, "Are these all adult size?" And I'm like, "Yes." And he just walked off, and I'm like,
"Why would you not?"
I'm like, "You don't have to eat it all at once."
We've got a neighbor who works for Hershey,
Anyway.
and he had they walk around full size candy bars, and like we were all talking about like whatchamacallits and all these like that the kids don't know anything.
Oh yeah, like the Zero bar,
which are sleepers. Those are the
absolutely.
bomb.
That's right. If you like the white chocolate,
yeah,
there you go.
Yeah. All right, well, great. Well, all right. So let's get to what the actual podcast is going to be about. Chuck, what is on your mind?
Engagement, viewer engagement. We had a comment from one of our previous podcasts, and one of our listeners wanted us to discuss investment planning. So, which was very unique. I'm happy the way he announced that, because investment planning is a different thing than financial planning.
Yep, significantly so. Well, obviously we'll delve into the investment planning, but let's prime the pump a little and discuss what is financial planning, and then of course we can talk about the difference between that and investment planning. Sure.
Well, financial planning is far more broad than just investments, and so you're talking about not just how you're investing for the future, but you're talking about insurance. You're talking about tax planning. You're talking about estate tax planning potentially. You're talking about lots of other things besides just investing. And it's also, this is actually an important thing for people to know. No one ever talks about in our industry, like, what do these letters behind people's names actually mean?
Yeah.
And when you're talking to someone who is a certified financial planner, a CFP, that means they have gone through a course of study which is very shallow but very wide. They know a little bit about a lot of topics.
Yeah.
And I'm not disparaging the CFP. There's value in that, but it is what it is. The CFP designation, if you look at those the classes you have to take, those are associate level classes. If you were to transfer that to college credit, so you're talking about a junior college level understanding of tax. So it's like, taxes 101.
Yeah.
It's estate planning 101. It's accounting 101. It's all these intros to different things, and that includes investing. And that's important because, the way most CFPs actually get paid is through investing.
Yeah.
And there is nothing in the CFP program that qualifies someone, in our opinion, to really be able to create an investment plan.
Sure.
It is a very rudimentary, just introductory level of what investing is all about. And now that doesn't mean that someone who has a CFP doesn't have that knowledge.
No, they may have gained that.
They may have gained it elsewhere, but they didn't get in the CFP program.
Yeah.
And so that is important to understand. So there is a difference between financial planning, and there's certainly a value for financial planning because it kind of touches on everything in your financial life. versus investment planning,
Yeah.
which is really geared towards how do we now manage this money.
Yeah, right. The financial plan kind of helps you ID what your goals are. It helps you zero in on what you are actually trying to accomplish.
Yeah, absolutely. And so, again, in the CFP curriculum, one of the one of the keys to it is understanding the time value of money, which is, again, it's fairly simple math, but it's the fact that, okay, how much money do you need to set aside today if you need this much money in the future?
Yeah.
Can you do that math? I mean,
Yeah.
that's kind of the backbone of a lot of financial planning. And then also, again, having kind of, an introductory level of knowledge of taxes and of different strategies and so forth and so on. So
Yeah.
that's and there's a lot of value because the CFP can oftentimes be your quarterback. That they're not qualified to actually write a will, but they know a little bit about estate planning.
Yep.
And so they can help you with estate planning. They're not qualified to be your accountant.
Yep.
But they know something about tax. They know something about accounting. They can help you in these areas. And I would argue that it's the same with investing.
Yeah.
They're not actually qualified to give you investment advice, but they know enough to kind of help you in that area.
The quarterback analogy is great, and I really haven't thought about it that way before because it's really kind of getting you in touch with and running all the other professionals that you should be having help you.
Yeah, absolutely. That's
Yeah.
a lot of what the financial planning process is about, is that you kind of have this one contact who's, not necessarily, they're not writing the will, but they're maybe referring you to the attorney or they're, what have you.
Yeah.
They're not actually doing your taxes, but they're working with your CPA and all of those kinds of things.
Well, they're usually not doing your investments either. Usually in most places, the CFP is simply relaying what their investment back office
is saying,
is
right?
saying to
Exactly.
in most
No, exactly.
instances, which is the same thing. So.
Right. Yeah, but so when it gets to the investment plan, you're dealing now more with, okay, we've done the financial plan. We know what our goals are. We know how much money we have to set aside. We know what our current portfolio is. How do we then manage it?
Yeah.
And one of the first steps in this actually is a little bit of a conflict with financial planning. So if you talk to a lot of financial planners, they're going to tell you, okay, you need an account for education. You need an account for retirement. You need an account for this and an account for that. And that comes from accounting. It comes from the fact you need to earmark these things.
Yeah.
But what ends up happening is that people end up then creating separate portfolios for all of those things. And this isn't controversial, by the way. I mean, this is just textbook right out of the CFA, curriculum. That is a very inefficient way of actually managing a portfolio. The way you want to manage your portfolio is as one portfolio. Yeah. And so that is a little bit different. And one of the things we always talk to our clients about is we want to be holistic. We want to look at all your assets. So that we make sure that we're actually managing them as one efficient portfolio, realizing that there may be multiple.
There may be other uses, but it's still
goals.
part of an overall portfolio.
Absolutely.
Truthfully, and it's that mindset from a planning standpoint that perpetuates some of those large issues you see with individual investors when they bucket money. And then you end up having, these tiny positions and these things that don't do anything and not understanding how it all works together as a whole.
Right. And that's another, it's another thing you have to understand is that the financial planning curriculum and that entire thing, it came from the industry.
Yeah.
It was not like this was an academic study and then the industry adopted it. No, this all came from the financial services industry. It evolved actually out of the life insurance industry and how they sold life insurance. And that is the roots of financial planning. And that's important to understand because the industry's conflicted.
Yeah.
And the industry wants you to bucket your assets.
Yeah.
The more accounts, the more transactions, the more money Wall Street actually generates.
Yep.
And so they love people out there giving the advice of, let's silo all of these things. But that is not the most efficient way for the actual investor to be managing their money.
And we're going to move into the plan, in the investment policy, the investment plan piece. But I do want to say, we've talked about this before, whenever dealing with a planner, if you're dealing with someone who can sell insurance, obviously that's the biggest of all conflicts of interest. You got to be really careful. So, because someone can choose to put money in an insurance product versus you manage it, they're going to make much more money in an insurance product.
Yeah, and there are lots of fee-only planners out there nowadays, but most planners historically they are selling insurance because again, it was the old insurance spill that what does your future hold? It's got one of three possibilities. You're either going to die too soon, live too long, or become disabled in the process. And we're going to plan for all of those three things. And that's where financial planning came from. Yeah. That was the kind of the initial stimulus. And so early on, most of the financial planners out there were really life insurance salespeople. Yeah. And then the brokerage industry got into it, and then now you have fee-only planners, and it's evolved from there. Yeah. But that is the origin.
Yeah. So now we can move into then the gentleman's question, which was, how do you create an investment plan? And we really think the first step in that is kind of the creation of the investment policy statement. So why don't we kind of start with that process and what that looks like? We've gotten past the financial planning part. Now we're moving into the next.
Right. Well, really, the investment policy is the investment plan. And so what you're talking about is creating what institutional investors for years and years have referred to as an investment policy statement. And this is something that we and firms like us have kind of taken from our institutional background and brought it to regular investors, is that the idea that your portfolio should be governed by an investment policy statement. And the first thing you do in investment policy statement is you lay out the objective of the portfolio. And the question we always like to ask our clients is, what is the most important thing about this money to you? And a lot of our clients think, well, that's kind of a silly question. I mean, what, you claim to have 30 years experience. You're a CFA, you've got all those credentials, and you don't know what's important about money. And we know what's important. We know what's important to us. Mm-hmm. We know things that are kind of important generally, and we know what's important to our various clients. But really, this is very personal, and it can mean different things. Mm-hmm. So, for some people, investing is all about security. Even whether they want to retire or not, they want to be financially secure. They want to have accumulated enough to where they know they don't have to worry about their financial future. And so for them, it's security. For others, it may be more goal-driven, like retirement or something specific that they want to do. For others, it may be status. Yeah. It's just, I have heard multiple people in my life come to tell me, that, it's a way of keeping score. And he's like, you can judge that attitude as you will, but there are people out there that haven't. Yeah. And so, for some people, it's almost a form of entertainment. They love following the portfolio. They love.
We've got clients like
right.
that.
No, absolutely.
Every move of every company, they want to talk.
Right. They want to talk about it. They want to understand it. They really love knowing what they own
Yeah.
and being able to talk about what they own, and for those people, that's going to impact how you end up investing.
My favorite is just when people say, "I want to make money." You get a lot of that too. First comment. What do you want to do? I just want to make money.
I just want to make money.
You got to dig deeper, obviously. but
We need a little more than that.
We need more, of course.
Okay.
We want to make money.
So no, absolutely. We will hear that a lot, and that's, I think it's because it's a question that isn't often asked. People don't. And I think a lot of our competitors don't. They just go immediately into kind of their sales pitch of this is what we can do for you. But we're actually talking about, how do you put out fires with the Atlanta Fire Department? So, welcome to recording in Buckhead.
That's right.
But anyway. No, we want to actually understand what is important to our clients.
Yeah.
And it is going to be deeper than just making money. Everyone, of course, wants to make, because the alternative to that is to lose. Although there are those that, perhaps it is more about keeping what they already have.
I'll never forget
than making more.
I'll never get the call, Chuck, we had when we got a call from a client. It was an awesome client who said, "Hey, we're actually making too much money right now," which she thought that meant we were taking too much risk. But the point is, people
Right. I think the actual comment is, "I don't need all this money."
I don't need all this money. I thought it was.
What am I going to do with it?
Yeah.
And we thought she might give it to her daughter, who referred her to us, but
don't argue.
But anyway.
Yeah.
No, you're right, and for that client, the most important thing about her money is protecting what she already has.
Yep. Mm-hmm.
She's not interested in growing it per se. Now, we did have to talk to her about how, we need to grow it in the good years because bad years will come.
Sure.
And the way that you keep what you have in the long term is you still have to grow it, when the time is right to grow it.
Yeah.
And then, and that allows you to, experience the step back, which inevitably comes.
Happens, and be okay with it.
And be okay with it, and still have maintained your assets over time. So, but that is the first step, is the objective. And we always talk to our clients on this. We will get into specifics, into actual translating that all to a number at some point, but we want this in plain English. We want to understand, and I don't want to just hear, I want to retire. Okay, well, what are you going to do in retirement? We want to talk about what I want to do is, 10 years from now, I'm going to sell it all, and I'm going to buy a boat, and I'm going to sail around the world, and that's my retirement dream, or whatever whatever it is. Those are the kind of things that we're talking about when that's the objective.
Yeah, let's get concrete here.
Yeah. And so that's number one in terms of creating an investment plan or investment policy, is that you have to, as Steve Covey says, you got to begin with the end in mind.
Yeah.
If you don't know where you're going, there's no way to then create the map to how to get there.
Yeah.
From there, we go into constraints, because, we're going to now invest this portfolio, whatever it is, and we want to know what are the constraints that we have in terms of investing.
Yeah.
The first one that we talk about is liquidity. Right? Is there a need for liquidity in this portfolio? And when we say that, the vast majority of what we invest in is or marketable securities, which can be sold.
If you need the money tomorrow, you can have it tomorrow.
Sold at any time. But what we really are meaning in terms of liquidity is there a known thing that's going to happen in the next few years that we need to plan for. Okay, so again, you have one portfolio. Your overall objective may be retirement, but you may also know that we're going to be doing a big home renovation in X number of years, in 2 years or a year. And so when we're looking at our holistic portfolio, we're going to need to keep some money liquid so that we can make that expense. So that's the first constraint. The second constraint we talk about is the time horizon. And this is really where people, this is probably the biggest constraint. This is where, frankly, a lot of the industry, this is the only constraint they look at. The entire retirement date, portfolios that you have in retirement plans are just based on this one constraint.
Yeah, the only single constraint.
It's your time horizon.
And it's a misunderstood constraint, truthfully.
It is, because your time horizon actually goes in stages. All right, so as we talk to our clients all the time, let's just assume that it's the objective of the portfolio is retirement. And I don't know, maybe it's a 45-year-old couple that we're talking to. They're going to retire at age 65, so they think, well, 20 years is
that's my time
horizon.
Yeah.
No, that is not true. Your time horizon is really the entire life of the portfolio, which in the case of a retirement portfolio is going to be your life expectancy.
It's your entire life.
Right, exactly.
Yeah.
And so you're 45, really their time horizon is 40 years, if not another 45 years. And now, we don't put that in our investment policies, as we've talked about in previous podcasts. My economic professors, when they were teaching us how to project out into the future, said anytime you're dealing with mathematical models, 20 years is infinity. And so that is, we just say more than 20 years.
Yeah.
But really, the whole time horizon in this case is going to be 40 plus years.
Yeah.
The 20 years until retirement for this couple is just stage one. All right. So the first stage is going to last until age 65 when they retire. And then you're going to transition into stage two, which is going to be the actual retirement years. And so the time horizon has stages.
Yeah.
And if you're talking about a more complicated investment plan, so maybe you've got, maybe it's a 45-year-old couple and they've got college education coming around in 10 years. And so stage one may be that 10 years until we got to take care of these kids going to college. Stage two will be from there to retirement. Stage three will be in retirement. That's the complexity of the actual time horizon.
Yeah.
And that's also where you're taking a holistic nature, as opposed to the way most financial planners would treat that, is that there's just three different things.
Yeah.
As if they're completely three different buckets. And again, that comes from the industry and the whole silo product mindset of the industry. But that, in our view, is not how you actually create an investment plan.
I mean, it's all your money.
Right.
You have different needs for it.
Exactly.
And you have to, ration those finite resources as you can.
Right.
Yeah.
Right. So the next constraint that we will talk about is regulatory constraints, because again, for the bulk of our clients, retirement's the number one issue. So most of that money is going to be in a retirement plan. There are rules governing retirement plans, and so that creates a regulatory constraint. There are things you can and can't do in a 401k plan that you could do in just a regular brokerage account, for example. And so there are going to be some regulatory constraints. Also for us, because we sign on as a fiduciary, and you hear a lot about that in marketing nowadays. You hear commercials about signing fiduciaries. Well, not all fiduciaries are created equal.
Yeah.
And so there is the ordinary kind of uniform investor level of fiduciary responsibility, which is as that one level of prudence that you must have with your clients. The highest level of fiduciary responsibility is governed by ERISA, which is what fiduciaries for retirement plans are called to, where everything must be done solely in the benefit of the retirement plan participants. That's the highest level of fiduciary responsibility. And for us, anytime we're managing someone's retirement plan, if it's a qualified retirement plan, a 401k, what have you, we hold ourselves to that ERISA standard, and we put that in the investment plan so that they understand that this is our fiduciary obligation to you.
Although truthfully, we hold ourselves to that level across the board.
Well, we do. But if it's a regular just taxable account, we because technically we are governed by the Uniform Investor Act, and so that's there is a difference there.
Yeah.
So there are regulatory issues, and that will also lead then to taxes. So taxes are a constraint. So if you're managing money in a retirement account, which is tax deferred, you don't have to worry about timing of sales or buys or realized or unrealized gains or any of these things. But if you're managing money in a taxable account, then taxes become an important issue. And the one thing we always tell our clients, which sounds so logical, but it actually goes against what a lot of people do in reality, is that we want to have a goal. It's a goal. We can't promise it, but our goal is to maximize our after-tax rate of return. And again, that sounds obvious to people, but that's not what most people do when it comes to taxes. What most people do when it comes to taxes is they do everything they can to avoid paying taxes.
Your step one is minimizing taxes to zero.
Right. And so we always tell our clients, okay, if you really truly want to minimize your taxes, lose everything you own.
Or at least don't make anything.
become completely broke, and
you'll have no tax implications.
You will not owe any taxes. And in fact, the government will give you money. And I don't think that's what most of our clients really want.
Yeah.
So what we want to do is we want to be tax aware. Another way of putting that quite simply is we don't want the tail to wag the dog. All right. We don't want to make a huge investment mistake that costs us thousands of dollars because we were trying to avoid hundreds of dollars in taxes.
Yeah.
I mean, and so don't let the tail wag the dog. But we do want to be tax aware.
Yeah, but we want to be smart about it.
And we want to be smart about that.
Yeah.
And then finally, the last constraint that people can put on the portfolio is anything that's unique to them.
Yeah.
So, maybe they don't want to invest in certain types of companies. Mm-hmm. Maybe they already have, and there could be tons of reasons.
Yeah, there's a million reasons.
Right.
I don't want to own banks. I don't want to own a company that makes guns or cigarettes or.
Right, or all of those
There's
things.
a million reasons personally.
Right.
Or
And for the vast majority of our clients, they will tell us that there are no unique constraints. But every once in a while it happens. So I remember years ago we had a client who there were no constraints on his portfolio. He just said, "What if it'll make money? We're good with it." He was in an income type strategy, and we purchased a tobacco company. I can't remember which one it was at the time, but the tobacco industry for years now, it's been a dying industry, but it is an industry that is a cash cow and pays out a lot of dividends, and so these are good in It depends on the market environment, but oftentimes they're good income type investments that will pay a high dividend. He had said he was fine with it. We actually did it. And when we did it, he's like, you know what? This just doesn't feel right to me. I don't want to do that.
Yeah.
And fine. So we created the constraint, no tobacco companies, and we went from there. So those are the constraints of the portfolio that will govern a lot of what goes into the plan.
Mm-hmm.
And then the next big thing is the thing that I think most people actually think about is the amount of risk you're willing to take and the amount of return you're aiming for,
Mm-hmm.
or need.
Yeah.
Based on your financial plan. And again, that's where the financial plan may come in, because it may say that, well, I need to get this percentage of a return.
Yep. Yeah, and there's an inverse relationship in a lot of ways between risk and return.
Correct. And so that is one of the reasons why when we do this, I think most people start with the return,
Mm-hmm.
and then they talk about risk on the backside. But we always like to begin with the risk. Because to coin a phrase, defense wins championships, but also, the risk tolerance is going to determine whether or not the return goal is realistic.
Yeah. Yeah.
You can't have a 12% return goal.
Yeah.
And then say, well, I don't want to ever see more than a 10% loss.
Yeah.
All right, those two things don't
exist.
It doesn't exist.
That is the stuff of Ponzi schemes. And Madoff, right? I mean, that's where those.
Absolutely, and we. I actually, told a prospective client one time that, well, I think what you're looking for is Madoff.
Yeah.
Because what you're asking for just isn't realistic.
Yeah, it doesn't exist.
And
it's a unicorn.
so that is that's not going to happen. And this is where if you're dealing with somebody, if it sounds too good to be true, it really is.
Yeah.
Yeah.
But we're talking about risk, though. Let's talk about the difference between ability and willingness, and how to think about those two pieces of risk.
We break down risk in two buckets, as you mentioned. The first is the investor's ability to take risk. And this, again, is a lot of times what the industry will just focus on in terms of risk, and then they make these big, broad blanket statements like young people should take
All
risk,
stocks, yeah.
and old people should be conservative.
Yeah.
For us, we will break down your ability. Your ability is going to be determined by the constraints. It's going to be determined by the time horizon. How much time do you have? If you do have a longer time horizon, you're able to take more risk.
The markets will bounce back.
Because exactly, you can recover from a downside. The amount of your financial resources will determine how much risk you're willing to take. So this is a great example, Michael, where if you're looking at different types of retirement plans, like you look at a 403B retirement plan. If you are a school teacher in a public school system here in Georgia, and we'll just use this as an example, this is true most states, may not be true at every state, but most states that I'm aware of, it's true. Public school teachers are one of the few employees in the world that still have a defined benefit plan. They have, in the state of Georgia, this sponsored plan called TRS, the Teacher Retirement System. And so a lot of their retirement is actually taken care of by this defined benefit pension plan that is just provided to them as a benefit for being a teacher in the state of Georgia. So if you are a teacher who's also then saving for your own retirement in what would be a 403B plan, which is very similar to the 401k.
Similar to the 401k
plan. If you're in that situation, then you have a much higher ability.
Your ability goes up
to take risk than a corporate employee that doesn't have any pension plan, and the 401k plan is the entire.
It's all you got.
It's all you have. And so you're really relying on it. Whereas with the 403B, it's really supplemental to your main retirement plan that gives you a much higher ability to take risks.
Yep.
However, we're stereotyping, but most personality types that go into teaching aren't big risk takers.
Yeah.
And so they may not have the willingness to take risk. And so there's a difference. Now, we may also get back to, you may have someone that is very close to retirement. They're right on the edge of barely being able to, financially retire. Mm-hmm. They can't take a lot of risk. They do not have a big ability to take risk. They need to hold on to what they have because they can't afford to take a loss. But maybe they've always been a roll the dice kind of gambler personality, and they have a big willingness to take risk. So those two things are very different, or can be very different.
Yeah.
And what we always do is we govern the investment plan based on the lower of those two. Whichever one of those is lower is what we do. Most of the time, it's the willingness that's lower. Most people can actually take more risk than they think they can, or feel comfortable doing. And so most of the time, it's the willingness, and those are pretty easy conversations to have. It's a little more difficult conversation when you having to talk to someone who doesn't really have the ability to take a risk, but they want to.
Yeah.
And that's a little tougher of a conversation.
Yeah.
But that's part of being a real fiduciary, is that you have to be willing to have
tough conversations.
Yep. And so that is the ability to take risks. The other thing we talk about all the time with risk is, okay, how do you actually define what is risk? All right, because most people in the industry simply put these big, broad, fuzzy titles like you're aggressive, or you're moderate, or you're conservative.
Yeah.
And those things are all in the eye of the beholder.
Yeah.
Because we've used this before, but Warren Buffett describes himself as a conservative investor, and he also says that if you're not willing to see your portfolio go down by 50%, then you shouldn't invest in stocks.
Yeah.
I mean, those two things don't compute to most people. No. But it computes to Warren because he doesn't invest in anything that he doesn't get to know intimately well.
Yeah.
And then he has a huge amount of confidence in it, and he just believes it's going to work out over time. And to him, that's conservative.
Yeah.
For most people, they'd be scared to death doing what he does.
Yeah.
And so really that's in the eye of the beholder. And so what we try to do in our plans is actually put a downside threshold on there and say, if we have a bear market, what's the worst case scenario, that you're willing to live with? And so just use last year as an example. When the bear market first happened in equities, the stock market went down about 26%. Mm-hmm. And that's pretty typical. So if you're going to be a 100% stock investor, you need to be willing over a short period of time to see as much as a 30% drop.
Because it happens.
Because it happens.
Yeah.
And now over time, that is where you'll make the most money. But at any given time, that's also where you're going to see the most downside. So that's that relationship between risk and return. And you got to act, in our opinion, you got to put an actual number on it.
Yeah, it makes a ton of sense. Because the way people, investors, participants, however you want to think about it, make the biggest mistakes is when they don't properly understand their own willingness to take risk.
Right.
And they sell at the wrong time. So what we're trying to do at that point is to stop the mistake that kind of can't be come back from, that you can't recover from, and that is the market goes down 40, you completely get out of 40, it jumps by 30, and you never get back in, and you have experienced a true kind of life-changing loss.
No, absolutely.
Yeah.
Absolutely. I think about this all the time. There's just a guy I met in a bar in the summer of 2009, and if you know, we'd just gone through the financial crisis. March of '09 was when we hit the bottom, and it just bounced back dramatically. And he was one of those guys, and he doesn't. They don't come out and admit it that way. He talks like he's the most sophisticated investor ever, you know, and like a lot of people, that as soon as they know what I do for a living, they'll start talking to me and, you know, want to prove that they know more about investing than I do. And he had sold at the beginning of '09, very close to the very bottom of the market. And he was still out of the market and was going to stay out of the market because, you know, this isn't over.
It didn't make any sense.
It's right. And I really wonder, because I've never seen the guy again, but you know, I wonder, I mean, how many years did he stay?
How long before he got back in?
Before he got back in.
Yeah.
And based on studies and you know, kind of the psychology of investing, which we've talked about before in our podcast, that he is probably waited way too long, and
He left a lot on the table.
and that causes a life-altering loss.
Yeah.
Whereas if you stayed investing through that whole period, even though, I mean, it was not fun for anybody, but you did recover from it. And so that's why the risk tolerance is so important, because we want to make sure that we can keep you invested. So we want to know at what level can we keep you on track.
Yeah.
And that's really important.
All right, so then we can move, I guess, on to the return objective.
Yeah.
Yeah.
So the return objective, again, part of this goes back to really making concrete what was kind of the soft objective at the beginning. Also ties into the financial plan. So you know, if we do the time value money calculation, okay, we want to retire, and we're going to need this much to retire, and this is how much we have, and how do you get from here to there? And ultimately, that becomes a number. And for us, as we believe that prudent investing is absolute return oriented, and this is where that return goal comes from. And so there's going to be a return goal for the portfolio, which is going to be, you know, whatever percent return we actually need to hit our targets. And that could be, you know, anything from 4% to 10%, or, you know, what, you know, it does need to be realistic.
It's got to be realistic.
Okay. And it also has to be a goal that is stated in terms of the long term, meaning a full market cycle. You know, so you're going to have years, if your goal is 8 to 10%, you're going to have years where you're going to have 20% returns plus. Otherwise, you're not going to hit that long-term goal, because there's going to be years where the market goes nowhere. There's going to be years where we are negative. You look at where we are right now, we've had that big bear market, and in reality, we really haven't recovered from it. We haven't come back, which is incredibly frustrating, because the economy has come back and companies have come back, but the stocks haven't come back because the pundits keep saying that recession we're predicting is going to happen next month. Next month. And so, you know, everyone focuses on the S&P 500, and earlier this year we had, you know, the AI phenomenon that drove that index up. But that you know, depending exactly where we are today, is somewhere 8 to 10% still below where it was before the bear market. But if you look at global markets, we're still down 20%. And
small caps even more. Small companies, even small companies in the U.S.
But if you look at a truly global portfolio, which includes the small caps, includes emerging markets, international markets, all the different asset classes, then you know, we're still down 20%. And so, but the point is, those things are going to happen along with the years that we get the big returns that people talk about. So your return goal has to be realistic, and And it is, and for some clients, we do have to talk to them about how it may be lower than what they think in their head, because they think about, well, what is my average return during a bull market?
Yeah.
Well, you also got to factor in the bear market that follows the bull market, and what is your average for that entire time period.
Yeah.
And so that's where we come up with the return goal. And those things are all things that we have, that's the input. That's most of that will come from the client. We'll guide them through it, but that's all the client's doing. And then it's our job to take that and create the output, which is the actual investment portfolio.
Yeah.
And that's sometimes where we get into some funny conversations as well.
Yeah, with clients.
Yes.
Yeah, when they've said these are all the things that I, want or think I need in a portfolio with the inputs of the investment policy statement, and then when you say, well, hey, here's what that portfolio would look like.
Right, exactly. So we will come back to the client at that point and say, okay, these are the goals. And it doesn't happen all the time, but it happens frequently, where you will sit there and you go through all the goals and objectives, the amount of risk they're willing to take, the return they're willing, they're aiming for, and then you will say, okay, well, this is what the portfolio is going to look like. And just in big broad terms, let's just say it's going to be 80% in stocks and 20% in bonds. And then they'll come back and go, well, I think I need to own more bonds than that.
Yeah.
And you're like, okay, let's go back. All right. So what do you want to change, in the input that's going to create this output that you artificially in your mind think needs to occur.
You need to take less risk. You want to make less money.
Right.
You want to lower return.
Right. And so we're going to lower your return goal. We're going to increase, depending on how you look at it.
Yeah, which way?
We're going to say you're more risk averse.
Yeah.
And so we got to change those things, to actually justify having a portfolio that looks the way that, for whatever reason, you have a preconceived notion that it should look like. And that does happen oftentimes with the clients.
Yeah.
Yeah.
And that's all part of what we call the portfolio policy, which is really, what's the portfolio going to look like, and how are we going to invest?
Right.
The portfolio.
Well, and then that provides we often refer to it as, this is the sandbox in which you're allowing us to play in. So that defines exactly how we're going to manage our portfolio.
Yeah.
And then we take over and we actually do it.
Yeah, here are the assets that we can
Right.
invest in.
Yep.
Buy and sell disciplines, when we choose to buy, what we choose to sell. Asset allocation.
Right.
All the rules with which we can, invest within. Yeah.
Correct.
Yeah. And then, because then we can talk about how it works for us. So once the investment policy statement is finished and that all has been agreed upon,
Mm-hmm.
we have to actually get to the point of creating an actual portfolio. So that's it. I think that's what we've got. That's how you create an investment plan.
Yeah.
So
there's a lot that goes
into it. So this topic came from someone actually making a comment to us. So if there's something you'd like to hear us talk about, please let us know. You can do that on comments, YouTube, anywhere, and send it to us by email, however. But we'd like to hear it because it's very helpful for us to hear what people actually want to talk about.
Right.
But please,
Yeah, including old school candy bars that we may not remember the name
the
of.
love of the zero bar.
Exactly.
And please like and share. That's always very helpful for us. So thank you.
All right.
Iron Capital Advisors is an independent registered investment advisory firm headquartered in Atlanta with clients nationwide. Learn more about us at ironcapitaladvisors.com. The Iron Capital podcast is produced by Iron Capital Advisors. Our awesome original theme music was written and performed by Michael Smith and Leah Calvert. This content is for educational purposes only and should not be relied upon for investment decisions or advice. Clients and employees of Iron Capital may maintain positions in the securities discussed. Please like and subscribe to the Iron Capital podcast on YouTube and